You were 41 pages deep into a complex credit stress model when the unexpected call broke through the Tuesday monotony. The persistent hum of servers you could never quite pinpoint, the stark glow of fluorescent lights, and the ever-present cold coffee defined your world. As a senior credit analyst, you were sharp enough to identify brewing risks, yet too junior within the hierarchy to decisively act on them. Your current assignment was a routine audit of Harville Bank Corp., a modest, family-run institution with $4.2 billion in assets. This was the quintessential community bank, the kind where the branch manager still knew every customer by their first name, their children, and even their pet's name. You had dedicated 11 years to this profession, building a reputation as thorough, careful, and a safe pair of hands. Nothing more, nothing less. The call came from a solicitor named Whitmore, his voice carrying the chilling precision of truly devastating news. He informed you that your mother's older brother had passed away, a man you had met perhaps 4 times in your entire life. A figure who had meticulously guarded his financial affairs and opinions with an almost impenetrable secrecy. You barely even remembered his face. Then came the revelation. Under a trust established 17 years prior, you were inheriting a controlling 53% stake in Harville Bank. Your pen clattered onto the desk. You couldn't speak. Nothing on your screen moved. Nothing anywhere moved, suspended in disbelief. The estate, Whitmore explained, was not liquid. The bank stock was not publicly traded. Crucially, there was no pre-existing exit mechanism, no prearranged buyout clause, no co-inheritor, no partner to share the burden or the opportunity. There was only you, and there was only the bank. A colossal responsibility dropped squarely onto your shoulders, unforeseen and undeniable. A board meeting was scheduled in just 9 days, and you were expected to appear to take your appointed seat. You slowly hung up the phone. Your eyes drifted back to the credit model still open on your screen, a ghost of your former life. With a decisive click, you closed it. The due diligence you performed over the next 6 relentless days became the most intense and thorough work of your career. You meticulously pulled every available filing, every regulatory examination report, every quarterly disclosure going back a full 8 years. What you unearthed wasn't an outright disaster, but it certainly wasn't healthy, not by any measure. A troubling 31% of the commercial loan book was concentrated in a single real estate sector, one that had been visibly softening for the past 18 months. Tier 1 capital hovered precariously at 8.4%. Technically compliant, yes, but a dangerously thin cushion. Deposit growth had flatlined. The bank's technology infrastructure lagged a decade behind the curve. You realized you weren't merely stepping into a role. You were looking at a complete rebuild. There was a $340 million loan portfolio your uncle had optimistically labeled as performing, but you harbored deep doubts. And then, you found something else entirely. A $60 million line of credit, almost fully drawn, which, through a labyrinthine path of 2 shell companies, traced directly back to the bank's longest-serving board member. You read it again, the words searing themselves into your mind. You sat with that damning document for an impossibly long time. You knew exactly what this was. You were an analyst, after all. You had spent 11 years seeing exactly this kind of malfeasance. The crucial question now was not what it was, but what you would do. Do you approach the regulator first, blowing the whistle and inviting external scrutiny? Or do you handle it discreetly, internally? Both paths, you understood, carried profound, irreversible consequences. These were not ethical questions in the abstract. They were acutely strategic ones, and you alone had to answer them. You appeared at the board meeting, clad in the appropriate suit. You spoke very little, choosing instead to simply listen, absorbing the dynamics of a system you were now irrevocably inside. Somewhere, that stress model of yours was undoubtedly still open on someone else's screen. Within 30 days, you quietly retained outside counsel specializing in bank governance. You moved with calculated speed and discretion. Your first official act was to request a full, independent review of the commercial loan portfolio, artfully framed as a routine post-succession audit. You then had one private, unhurried conversation with the implicated board member, the one whose name appeared on the holding company. The exchange was cordial, but your words left absolutely no ambiguity about what you knew. 2 weeks later, he tendered his resignation, citing health reasons. The $47 million line associated with him was immediately placed on watch status. No regulator was ever officially notified. This was a deliberate choice. You understood that protecting the institution ultimately protected you. You would revisit this decision for years, sometimes believing it was wrong, yet you would never change it. The credit review returned, revealing an even worse picture than you had anticipated. $218 million reclassified as substandard, and 3 loans moved to non-accrual status. Tier 1 capital plummeted to 7.1%. You were now exposed, vulnerable. The bank remained solvent, but it was far from comfortable. You were now responsible for every single bit of it, for $2.9 billion in deposits and 84,000 customers who remained blissfully unaware. You stopped sleeping the way you used to. The immense weight of it never truly left you, even in the darkest hours of the night. The capital problem presented 2 stark solutions: raise additional equity, accepting the inevitable dilution, or aggressively shrink the balance sheet. You opted for a hybrid approach. You brought in a single outside investor, offering a 12% stake in exchange for $85 million in fresh capital. Crucially, they received no board seat and no operational control. You retained the majority stake in every decision that truly mattered. With this injection, Tier 1 capital improved to 9.2%. The regulators, who had been closely observing your every move, went notably quiet. You had bought yourself precious time, and you intended to utilize every single day of it correctly from that point forward. You promptly hired a new chief credit officer, an experienced professional who had navigated through a full credit cycle before. You established an internal credit committee, endowing it with real authority to challenge and push back on any instances of relationship lending. Without hesitation, you terminated 3 senior loan officers who had consistently approved credit based on personal connections, not sound financial metrics. One of them had been a fixture at the bank for over a decade. Another wept in your office. You provided a fair severance package, but you deliberately did not allow yourself to feel more than was pragmatically useful in that moment. You were rapidly transforming into someone who understood the crucial distinction between what was merely difficult and what was fundamentally wrong. They were, you realized, not the same thing at all. By month 9, the non-accrual portfolio had begun to shrink, a tangible sign of progress. The loan book was finally becoming structurally sound. The bank wasn't actively growing yet, but it was undeniably becoming the kind of institution capable of sustainable growth. Now, your thoughts turned to what the bank could become, rather than being fixated on what it had been. That fundamental shift in perspective was everything. 18 months into your tenure, you initiated your first strategic acquisition, a well-run, deposit-rich community bank located 40 miles north of the city, boasting $680 million in assets. Its owner was looking to exit, and no clear succession plan was in place. The asking price was $92 million. You skillfully negotiated, eventually paying $88 million in a combination of cash, stock, and a subordinated debt issuance. Regulatory approval arrived swiftly, in just 4 months. With this acquisition, you had officially crossed the $5 billion mark in total assets. This threshold mattered immensely. Crossing $5 billion in assets automatically triggered new, more stringent regulatory requirements, enhanced stress testing, more detailed reporting mandates, and intensified scrutiny on every aspect of the bank's operations. You proactively hired the necessary talent and built the required infrastructure. You did not wait for the scrutiny to arrive, unprepared. You were no longer merely managing a bank. You were actively building one. The difference between those 2 endeavors was not small. You had ceased thinking about individual loans in isolation, and now your focus was entirely on managing comprehensive portfolios. This demanded a fundamentally different kind of strategic mind. You had stopped merely reacting to problems as they arose, and had begun to proactively design the underlying conditions where problems were far less likely to form in the first place. You were operating at a significantly higher level now. It didn't feel like a distancing from the actual work. Instead, it felt like profound control. At $5.4 billion in assets, you began to truly grasp the immense, quiet power a banking charter could afford you. You started originating loans and strategically selling them into the secondary market, thereby generating valuable fee income while prudently managing your own exposure. You expanded into offering sophisticated treasury services to municipalities. You participated in larger, syndicated loans. You learned to manage risk effectively without having to carry all of it on your own books. Every dollar of assets now generated a subtle return that flowed directly to you, silently compounding, largely unremarked upon by anyone outside your inner circle. It wasn't the explicit flow of a salary, nor the occasional surge of a bonus. It was the quiet, almost invisible way capital truly flows, often without overt permission. You found yourself reflecting on your uncle, who had presided over $4.2 billion in assets, and yet had said nothing to you about it for 40 years. You pondered what insights he possessed that you hadn't. His silence no longer felt unkind or enigmatic to you now. It felt like a knowing wisdom. 3 years into your transformation of Harville Bank, the regional economy delivered precisely the scenario your models had anticipated but fervently hoped would never materialize. Interest rates moved faster and more aggressively than predicted. Commercial real estate, which had shown fragile signs of recovery, abruptly stalled and then reversed course with brutal force. Two significant borrowers began exhibiting early, undeniable stress signals. Their combined loan exposure stood at $74 million. It wasn't immediately fatal, but it was certainly not comfortable. You had to decide, and quickly, before the situation escalated from one to the other. There was no room for delay. You had two clear options. You could work collaboratively with the borrowers, extending maturities, restructuring their debt, and absorbing the associated costs over a period of 14 months. Alternatively, you could call the loans immediately, force liquidation, absorb the loss right away, and maintain a completely clean balance sheet. Liquidation was the faster route, but it invariably destroyed viable businesses and shattered the lives of the people who worked in them. You had meticulously run the numbers. You chose the workout, not because you were overcome with sentimentality, but because the mathematical expectation of loss was demonstrably lower through this approach. Yet, in a quieter corner of your mind, you also noticed, for the first time in 3 years, something akin to mercy. You weren't entirely sure whether the cold math had come first or the unexpected flicker of empathy had. You chose not to scrutinize that internal question too closely. The workout process extended over the projected 14 months. Final losses ultimately came in at a manageable $14.3 million. Your models had held true. Your credit officers, in their next quarterly review, exchanged knowing glances, a silent acknowledgement that, indeed, we built for this. Everyone understood it. By year 4, Harville Bank held $6.8 billion in assets. Net income reached an impressive $94 million. Your private equity stake was now conservatively valued somewhere between $380 million and $420 million. You had not sold a single share. You had not drawn a salary exceeding $600,000, not even once. This wealth was entirely structural, retained earnings, robust capital ratios, and an institution compounding value, leveraged on other people's money. You now fully understood why your uncle had lived such a quietly understated life. The sheer scale of that number bore no relationship to ordinary daily existence. It existed on paper, abstract, feeling almost permanent, yet it was entirely dependent on the continued stability of a bank that could, at any moment, still experience a run. You never told anyone that precise number, not even an approximate range. No one knew. In year 5, a significantly larger bank approached you. A $40 billion regional institution, publicly traded and rapidly expanding its footprint. They wanted Harville. They presented an offer of $680 million for your controlling stake, with absolutely no conditions attached. This valued the entire bank at over $1.2 billion. The offer was perfectly clean. No earn-out clauses, no lingering operational role required. Just take the money and walk away. Never think about credit risk ever again. You sat with that offer for 3 full, agonizing weeks. You did not reveal its existence to a single person. Ultimately, you declined it. Your reasons weren't purely financial, but they weren't purely emotional either. Both were undeniably true. You had spent 5 grueling years building something that functioned as vital infrastructure, something genuinely critical communities depended on. Selling, you knew, would mean ceding crucial decisions to people whose primary interests would not necessarily align with the communities your bank served. You had witnessed firsthand what acquisition integration looked like from the inside, and you knew exactly what always got cut, what vital connections were inevitably severed. You declined, fully aware that this decision might cost you $300 million in liquid wealth that you would never recover. Still, you made the choice anyway. You weren't entirely certain it was the right one, but you were the one who had to make it. Then, in year 6, something unfolded that you had neither modeled nor could have possibly planned for. It arrived without fanfare or warning. A competitor bank, holding $2.1 billion in assets, failed its stress test. The FDIC quietly initiated a resolution process, discreetly seeking a buyer. Your bank, to your surprise, was on their short list. You were given 18 days to make a decision. This acquisition would propel you to nearly $9 billion in assets, crossing yet another major regulatory threshold. But if you moved with sufficient speed and precision, the purchase price would land comfortably below the failing bank's full book value. The math was unequivocally clear. At 6 o'clock in the morning, you authorized full due diligence. By noon, 22 analysts were deep within the data room. By day 3, you knew your number. You knew precisely what you would pay and what you would write off. On day 7, you submitted your bid. On day 12, the FDIC called back with a counteroffer. You responded the very same day. On day 15, you closed the deal. Harville Bank Corp. was now a formidable institution with $8.7 billion in total assets. You had not appeared on any public lists. You had not given a single public interview. No one outside your carefully constructed world knew the full extent of your operations. But within the tight-knit community that obsessively tracked balance sheet growth and acquisition pace, they all knew your name now. The calls began to pour in. Offers for partnerships, major deals, hints of political appointments, a $400 million state treasury deposit relationship. A prominent private equity firm called, seeking you as their banking partner for a distressed credit portfolio. You answered calls selectively, with a new, critical skill. The most important lesson now was knowing when to strategically withhold capital, not to deploy it. You wielded power in a way that bore little resemblance to external perceptions of power. Nothing about it was overtly visible. There was no ceremonial title, no public authority, just a meticulously clean balance sheet and an institution that deliberately avoided drawing attention to itself. In your entire region, very little significant commercial activity moved without touching your bank somewhere in its intricate chain. Very little indeed. Tonight, a credit committee report awaited you in your inbox. There was always something waiting. 3 more commercial loans were showing early stress signals. The rate environment had still not stabilized as your carefully constructed models had predicted. A board member was asking politely, but with persistent intent, about your succession plan. He would keep asking until you provided an answer. You were 44 now, 6 years into running this institution. The tiredness wasn't what you had anticipated. It wasn't the sheer exhaustion from the work itself. It was the profound fatigue of knowing exactly how many intricate things had to go precisely right, simultaneously, for everything to hold together. The balance sheet was healthy. Capital was adequate. Your management team was the best you had ever assembled. Yet, none of that meant anything if the wrong sequence of events arrived on the wrong Tuesday. You knew this truth deep in your bones. You closed the credit report. Then, with an almost ritualistic sigh, you opened it again. One specific loan held you captive at your desk tonight. $38 million to a warehouse distribution company. Leverage was above 5 times, and covenant headroom was visibly thinning with each passing quarter. The credit officer recommended a covenant waiver and a 90-day review. You weren't entirely sure you agreed with his assessment. You had seen this exact shape before, this specific, insidious gradient of decline. You already knew precisely where it ended. The last time you had observed this pattern, the 90-day review had spiraled into a grueling workout, which then inexorably became a substantial loss. You remembered it vividly. You set the report aside for now. You would think about it in the morning, when your judgment was clearer, unclouded by the late hour. Not now. The market was already moving without you. Tokyo had opened. Shanghai was actively trading. The night possessed its own relentless logic. Somewhere in the overnight session, capital was shifting in profound ways that would inevitably reach your desk by morning. Every night, you grappled with the understanding that you had not created these powerful forces. You could not stop them. Your only recourse was to build the institution robustly enough to absorb whatever came next. You had built a bank, or perhaps you had inherited one, and, through sheer will and intellect, transformed it into something that actually worked. The distinction between those two origins blurred. The distinction mattered less now than it had on that very first Tuesday. Everything seemed to matter both less and more, all at the same time. The calls would come again tomorrow. The decisions would be real. They were always real now, every single one of them. The losses, when they inevitably arrived, would ripple through businesses and impact countless employees, subtly altering the slow arithmetic of regional economic life. You would make the best decisions you possibly could with the information you possessed. Some of them would be wrong. The wrong ones would cost money you could absorb, or perhaps money you could not. You would discover which when the moment arrived. Then, you would ultimately face what every person who has ever truly controlled a financial institution has eventually had to face. The moment when the institution itself becomes larger than you. When the balance sheet develops its own inexorable logic and its own implicit will. When the market does not pause to ask for your input before delivering its impartial verdict. It never has. It never will. You were not afraid of that moment. You had been preparing for it, consciously or unconsciously, since the very first Tuesday it all began. But you were not ready for it. No one ever truly is. That, you mused, was the profound, unquantifiable part that never appeared anywhere in the official filings. The clock on your desk read 11:47. The markets would open in 6 hours. You got back to work. You always did.